Welcome to the Wealth Studying Podcast Video Edition. I'm your host, John Pugliano. I'm also the founder and money manager at investablewealth.com. Now, you've often heard me talk about how I use simple moving averages as part of my overall stock trading strategy, and I use a fairly complicated method to track the stocks that are on my watch list, and that's how I determine when I move in and move out of my stock positions. But I do this as a professional. You don't need something that complicated. You don't have to go out and develop your own program or spend thousands of dollars buying some software package that does it for you. What I'm going to teach you in this video is just a very easy method that you can use right at your computer. As long as you have access to Yahoo Finance, you'll see just how easy it is to chart a simple moving average. And you can use other methods. I'm sure that Google and CNN Money and all types of other websites have something that's probably very similar, but I'm going to tell you, I've been trading stocks for over 30 years, and I've used Yahoo Finance since it came out, back 1996, something like that. And this is a very powerful method. There's more information and more tools available for you over at Yahoo Finance than Warren Buffett ever had before he made his first $1 billion. So don't be afraid to go over and use Yahoo Finance. Don't think that it's old school. Obviously Yahoo hasn't kept up when it is in terms of things like Gmail or Google has definitely beat Yahoo out when it comes to things like search, but Yahoo does an excellent job with Yahoo Finance. In fact, I would tell you that I think that Yahoo Finance is probably the best thing that Yahoo owns. It's the best part of the Yahoo franchise. In any case, you know that I'm a big fan of simple moving averages, and I've gotten a lot of question of how people can draw them. And so the purpose of today's video is not to go into the esoteric part of why you would want to use the average. It's simply to show you how to chart it. So let's get started. Well, obviously the first thing we want to do is start off by going to yahoo.com. When you get there, you can click on the Finance tab. That brings you to the financial part of Yahoo. And you could put whatever stock you're interested in, put the ticker symbol there and hit search. We're just going to use the S&P 500, which I can click on that tab right there. That takes us to the summary page. Because we're interested in the chart, we're going to click on the interactive chart tab right there. That'll allow us to look exclusively at the chart. If you do want to go back information about the stock, like news items or price per earnings ratios, things like that, you can click right here on the return to the summary page. But for our purposes today, we're just going to worry about the chart. Now, when you bring up the chart, I don't know what it's going to be defaulted at, but it may not be in the same time frame as mine. That's easy to change with these tabs right up here. You can see the 3M is for 3 months. We can look at a chart over the period of a day, over 3 months, or all the way out to like 10 years. I'm not a day trader. I don't fool on the 1 and 5 days. My emphasis tends to be on the 3 to 6 months. And really the charts I use the most are the 3-month, the 6-month, and the 2-year. That's because I'm a swing trader. I trade over a period of weeks and months, not over days or minutes. So for our purposes, though, we're just interested today about finding a simple moving average. And the way we do that is we click on Add Indicator. Click on that. You can see right here, simple moving average. That's exactly what we want. You can just add it by clicking this positive button right here, this little plus. And you could put as many in there as you want and then go in and change them from a 50 to, say, a 5 and a 10. Just like that. If you decide, I don't really want these two, you can just get rid of them there. Or if you don't want to edit them at the Add Indicator tab, you can simply come right here and delete them as well. Okay, just give you a quick overview how that works. You can also come in here and change the thickness. For example, I'll make the line thinner or make the line thicker. I can change the colors as well. Okay, now I personally like to keep my particular stock I'm looking at on black with a thick line, and then my indicators I like to keep on a thin line unless I'm using multiple indicators, and I'll show you that in a minute. For our purposes, just to make it show up a little bit better on the screen, though, I'm going to make it large. Okay, now we are looking at a 5-day moving average. No, we're not. We're looking at a 5-period average, okay? Now, generally, you'll hear me speak about moving averages as days, 5-day moving average, 50-day moving average, things like that. Those are what's most useful to me, again, because I am a trader that trades over a period of weeks and months, and so I want to look at the way the price is fluctuating from its average price over a period of days. But when you go into Yahoo, and this is the most confusing part that people have with this is not indicated in a time frame. It simply says a period. And so depending upon what type of chart you're going to look at is going to determine what that period is. We have the number 5 here. We're in a 10-year chart. And so if we look across the bottom right here, every time I move my cursor, each tick mark represents a month. It goes from May to June to July. So each one of these is a month. So the period is a monthly period. So this green line here would be a 5-month chart. If I wanted to look at, say, like a moving average over a year period, I'd put in 12 because there's 12 months in a year, and you can see I get a nice pattern of a 12-month moving average. You know, again, for my purposes, though, I really like the day moving average, and so if you use the month chart all the way out to the 2-year chart, they're all going to be in days. Every tick mark is going to be a day. You can see them changing across the bottom of my screen, and so that 12 there now would represent a 12-day moving average. If I want to look at that on the same scale and make it a year, I would put in 200. The 200 period would be 200 days, and that's because, you know, the stock market isn't open 7 days a week. It's only open 5 days a week, and so in general there's probably about 225 trading days in a year. But Wall Street makes it simple and abbreviates it, and they simply call it a 200-day moving average. So now that green line represents the moving average for the S&P 500 over a 1-year period. The black line is the daily price of the S&P 500 over this period of 2 years, from March of 2015 all the way up to the present when I'm recording this in March 1st of 2017. So it gives us a nice snapshot of what the index looked like over a 2-year period, and then we can see that moving average. When I'm looking at a moving average on a 2-year chart, though, I'm probably going to drill down and maybe make this a 50-day moving average, which would be about 2.5 months. And the reason that's important is because earnings come out every quarter. So every 3 months, you're getting a new earnings report. And if you look at things on a 50-day moving average, that smooths things out over a 2.5 or 3 month period. And it takes some of the noise out of the everyday movements of the stock market. Again, more about moving averages in other episodes if you're interested. In this one, I just wanted to show you how to draw it. So we can come over here, we can turn that off if we don't want to look at it, we can turn it back on by clicking the eye, we can get rid of it, it disappears. We can go back up and put indicators back in again. I'm going to click this about 4 times here. Let's go in. Now, I like to look at, say, the 20-day moving average. That gives me what the market looks like over a period of about a month. I like the 50-day moving average, which gives me about a 3-month period. I like a 100-day moving average, which tells me things over a 6-month period, and then a 200-day moving average, which occurs over a year. Oh, now look at those. That looks like a big jumble there. But I can come in here and if I just want to focus on, for example, the 50-day, I can make that larger and just look at the 50-day. And I can see where that's at. I can see how the market broke out above the 50-day moving average here last spring in 2016, how it came down, it got support on the 50-day moving average, it fell apart but then broke back up and moved on, and I may be able to gather some information from that 50-day moving average. On the other hand, I might want to focus on more short-term trading and just look at the 20-day moving average. So I'm going to focus on it that way. I also may want to look at when the 20-day moving average crosses the 200-day moving average. And so you can see the 200-day moving average, that's a 1-year average. It's nice and slow and takes a lot of noise out. It's a very gradual line. Where the 20-day moving average is much more volatile, as you would expect. In fact, I may want to not even look at the daily stock price because there's too much noise there, so I can take that out. I can take out the 50-day because that's just going to confuse me. I can take out the 100-day moving average. And now I'm just looking at the very smooth 1-year average of the stock market. We can see that for the better part of last year, this blue line is indicating that the market didn't do very much, and then around election time it started to break out and we had an overall uptrend in the moving average. At the same time, we can look at the 20-day moving average and see that there was a great deal of volatility last year, but once the 20-day moving average finally broke out above that 1-year moving average, the 200-day moving average, it consistently moved up, and we can see that we were in an uptrend during that period. That's one of the benefits of using these moving averages. So let's turn them all back on, just to show you how to do that. I'll turn that one off. Just turn it back on, turn on the 50, turn the 100, and you know what, let's say I want to get rid of all these, okay? And you're going to do this. You're going to come through and find out which ones you like to work with best. Let's turn them all off except for, I'm going to keep on the 100-day. I'm going to turn the S&P back on. And with something I want to point out here, and we're going to do it over a longer period of time. Let's go back up to that 10-year chart. Let's turn on the actual price. So there's the price of the S&P 500 over the last 2 years. Here was the financial crisis of 2008. The market bottomed out in February, March of 2009. It's been in an uptrend ever since. We need to change this back to, I want to put this to symbolize about a 100-day moving average, which in this case would be 6 months. So this is a 6-month moving average. And I want to show you how powerful, one of the reasons I really like this. I want to change the color here too so it shows up a little bit better, so make it thicker. Okay, so the black line is the monthly average price of the S&P 500 over the last 10 years. Look at how powerful this 100-day moving average is. The price almost never dips below that average. It'll get right to it. So if you came out of the financial crisis in March of 2009, you saw that the price broke out above what had been a declining 100-day moving average, or a 6-month moving average in this case. You can see that once the price got above that, it never tended to go back down. And that was a good indicator that we were in a rising market. And for people that don't believe in moving averages, just look at how accurate the price follows that. Every time it hits it, it gets support and it moves back up. We'll talk in other episodes as to why that happens. But you can see that really all the way from, you can argue, you can go all the way back to 2009, but really from 2011 all the way until 2015, the summer of 2015, the S&P 500 never really broached that 6-month moving average, or that 100-day moving average. And that was a really good indicator that we were in a positive uptrend. But in 2015, when things started getting real choppy again, that was an indicator that maybe the market will go farther down. You can see we have bounced up above it here right around the election. And we'll see if that actually holds out and we go farther, or if support breaks down and we have, something like this happen again. But I digress. In any case, the purpose of today's video was just to introduce you to how easy it is to chart a simple moving average using Yahoo Finance. It's a powerful tool. Let me know how you like this video. If we get enough responses and there's enough interest, I'll come back. I'll do some more series where I talk about how I incorporate simple moving averages into my overall market timing strategies. For the Wealth Studying Podcast, this is John Pugliano wishing you the very best returns.